Hello guys, I hope I am audible to all of you. This is the day 2 of Practice to Pass session for September 2020. So we will just start from where we ended yesterday, and I gave you people assignment of calculating different financial ratios of Gorva company, and we were supposed to discuss this question with regards to whether the company is over trading or not, and we had to look at different financial ratios, the indicators of whether the Gava company is overtrading or not. So a quick recap of what overtrading is. Overtrading, as we discussed earlier, is something where is a situation where a company tries to increase its trading volume without sufficient backing of long-term investments or resources. And if a company is in such a situation where its trading volume is increasing significantly and it does not match its capacity when we look at its long-term investments, the capital required to support such a huge level of trading volume, then this company is said to be over trading. And it's never advisable for any company to be in such a situation, as this situation backfires the company, because the company, in order to increase its sales, it also requires investment with regards to capacity building, for which it may have to increase its physical space of the factory outlet where it has to produce more units. It may have to invest in plant and machinery to support the production volume. It also has to hire workforce, for which it will be needing more working capital. It will also have to increase its distribution channels. Again, investment will be required. So it has to have uh, backing of the investment to support such level of sales volume. But if it fails to provide the matching level of investment for a huge level of trading volume, then there is a great chance that it will fail to pay off its debts on time. Because of not having sufficient capital, the reliance of the company will be more on short-term financing, because for any long-term financing, usually the lender will be asking for collaterals, for security, for fixed assets to be mortgaged as security. Since the company may not have sufficient assets, so there is a great chance that the company will be relying too much on its short-term source of finance. And when those short-term debts will fall due, the company may not be in a position to pay those debts. And in that case, the company may move towards bankruptcy. So that's why it's never ever good for a business to be involved in overtrading. So it is very important for a business to continuously evaluate its situation and see if it's overtrading or not. So similarly, we have a question in case of a Gova company, and now we are going to start and see if the company is overtrading or not. So I asked you people to calculate these financial ratios. So let me calculate these financial ratios now, and then we will be discussing whether the company is overtrading or not. And I'll also be discussing how you should be writing this question in your exams. So first of all, let's see what's the sales growth. For the sales growth, we need to see by how much has the sales increased as compared to the last year. So the current year sales 13632 divided by 12750, the previous year sales, minus 1. Oh, I'm sorry, this is not sales figure. I've picked up the wrong figure. The sales figures are at the top. Sorry. $37,400 current year sales figure divided by the previous year sales figures, 26720 minus 1. So it's 39.97%. So the sales have grown from sales have grown from 26720 to 37,400, which is 39.97% increase. So we don't need to calculate it for 2006 because we are comparing it with 2006. So now asset turnover ratio, we need to calculate asset turnover ratio for both years. And for asset turnover ratio, we need sales figure for the current year. That is 37,400. And we have to divide it by capital employed. And capital employed is equal to total assets minus current liabilities. So the total assets figure, do we have the total asset figure or we have to calculate? Okay, we have to calculate the total assets figure, right? So they have given us the net current assets, which means they have already deducted the current liabilities from this figure. So we just need to add these two figures to get the capital employed figure, 13632 plus the net current assets, and the net current assets means they have already deducted the current liability. So 1225, that's the capital employed figure. So the asset turnover is 2.52 times, and let's calculate for the previous year. Again, we have to pick the sales figure. It's 26720 divided by the non-current assets and the net current assets. So the non-current assets are 12750 plus net current assets 1000. So here we go. The asset turnover ratio has increased. Now, if we have to interpret this ratio, it means that the sales have grown, but the capital employed hasn't grown in line with sales. Even if there is an increase in the capital employed, the required level of capital employed is not there. If you can just look at it, 13750 is the capital employed for 2006. In 2007, the capital employed figure is higher than 2006. So there is an increase in the capital employed figure. There is more investment in the capital employed, but the asset turnover ratio, the increase in asset turnover ratio suggests that this figure hasn't grown the way sales have grown. The sales have grown by 40%. So it means that the growth in the capital employed isn't 40%. So the increase is not matching with the increase in the sales figure. So this is now one of the signs of over trading, and when we will be discussing it, we will take this into account. So let's first do all the clerical work and solve the calculate these ratios. Now let's come to the current ratio. For current ratio, we need current assets, and the current assets are 9,200, and the current liability 7975. So 1.15. It's better to write up to 2 decimal places. And then we have 4600 divided by 3600. So So there is a decline in the current ratio. So another symptom of over trading is here. Now let's calculate the current quick ratio. Now along with these ratios, I will also tell you the interpretation of the ratios. What does the current ratio mean? Current ratio means that you to pay off $1 of your current liability, you had $1.28 of current assets in 2006. Whereas in 2007, to pay off the same $1 current liability, you only had $1.15 of current ratio, sorry, of current assets. So to back up to back up your liabilities, you only had $1.15 of current assets to pay off your debt. So definitely you are in a bad situation than you were in 2006. Of the current assets, there is also inventory in your current assets, and we all know it takes time for inventory to get converted into cash, because to pay off your liability you cannot simply give the inventory to your payables or to your suppliers. You definitely have to pay them in cash. So inventory will take some time to get converted into cash. So that's why it's not called a quick asset. So even if we have $1.15 of current assets, a part of this 1.15 consists of the inventory, which will take time to pay off debts. So we cannot still believe that we are in a position to pay off our debts unless and until we calculate the quick ratio by dividing quick assets by the current liabilities. So now again, let's take the assets, but we will just take trade receivables as our quick assets, 4600. We will just leave inventory figure and divide it by the same liability figure, which is 7975. So 0.57. Similarly, we will just take 2200 and divide it by 2400. Sorry, 3600. So even if we look at the quick ratio, we were in a better position in 2006 than we are in 2007. Okay, I'll just take a break of 2 to 3 minutes for Azan, and we will resume after the Azan break. So guys, back. Okay, then now let's move towards the gross profit margin. For gross profit margin, we need gross profit and we have to divide it by sales. So the gross profit is 2992. Okay, do we have gross profit? Okay, we only have operating profit straight away, and they haven't calculated the gross profit and the net profit separately. So let's take this figure and just concentrate on the operating profit now. So we'll just remove this. So operating profit margin. So the operating profit margin will be equal to 2992 divided by 37,400. 37,400. And let's change the format of the cell. It's 8%. And for the last year, it was 2939 divided by 26720. So again, there has been decrease in there's been a decrease in the operating profit margin as well. Okay, then we have sales to working capital ratio. Sales 37,400 divided by working capital. The working capital is basically the net current assets, which is 1225. So we don't need to calculate it again because net current asset means working capital. From the current assets, they have already deducted the net current liabilities. So the net current assets 1225, 31. Okay, and for this previous year, the sales figure is 26720. 26720 divided by net current assets, which is 1000. So it's 20, it was 26.73 and now it's 30.53, which shows that your sales have tremendously increased and you haven't increased your working capital investment as much you have increased your sales. Then we have receivable days. So for receivable days, we need the receivable balance. Okay, the trade receivables are 4600,000 and the receivables will be divided by sales 37,400 into 365. So it's approximately 45 days. It's better we write it to whole number. Then we have a receivable balance of 2200. We had a receivable balance of 2200 at the end of 2006. This 26720. 26720, the sales figure, and multiply it by 365. It's 30 days. So you can just simply look at it. It has also increased. So we'll discuss it later on. All these ratios will be taken into account. Now let's go to the payable days. For payable days, we need the payable balance. The payable balance was 4750 for 2000 and should be divided by cost of goods sold. 34408 34408 into 365 50, and let me use the same formula, but let's change the figures. So the payable figure for 2006, it's 2000, and sorry, should be in the numerator, and they've divided by the cost of goods sold figure, which is 2323781 23781 23781. Okay, are we making any mistake? Yes, I've just put a comma sign here. Okay, from 31 days it has gone up to 50 days. So inventory days, for that we need inventory balance. The inventory balance was 4600 for year one, and the cost of goods sold figure, which is 34408 34408 into 365. What's 2200, Abdulaziz? Was it 2200? Yes, I've used 2200, the receivable balance. Okay, for inventory days, for the last year inventory, the 2006 inventory balance was 2400, and the cost of goods sold was 23781. 23781. Okay, 365. So it's 37 days. So we're done with all the ratios, and so we're done with all the ratios. Now it's now the main part, that is the discussion part, in which we have to discuss, looking at these ratios, whether the company is over trading or not. So let's discuss now. Now, how are we going to start? First of all, my suggestion to all of you, you should always look at the marks available for a question. This will help you plan your answer. So there are, how many marks are available for this question? We have 10 marks available for this question. And we got a question from one of the students that why do we have to do so many calculations for a 10 marks question? I think 10 marks are good. 10 is a good number to get marks. So I don't think we have still calculated enough for these 10 marks. So and even if the examiner has asked us to suggest whether the company is over trading or not, we must calculate all these, because these ratios will help us reach to a conclusion and justify. When we'll be saying that the company is over trading, we will have a justification. So we have to be very sure whether the company is over trading or not. Just because of increase in sales, we can't simply say just the company has increased its sales by 40%, it means it's over trading. No, by no way, by no means we will be saying just looking at one or two symptoms. So all the combination of a majority of these symptoms will suggest that the company is over trading. So let's now discuss. So 10 mark for 10 marks, what you have to do. So I'll give you a structure of how you should be writing in your exam. First of all, look at the marks available. Look at the marks available. If you feel that there is very little to discuss and the marks are more than what you are going to discuss, then the examiner is also aware of this fact. So if you have less points to discuss, but there are more marks there are more marks available for the same question, then it means that the examiner wants you to start with an introductory paragraph. So you have to give an introduction of the topic that you are discussing. Like here we are discussing the over trading, And the marks, as far as I'm concerned, the 10 marks are sufficient. So we have to start with introduction. So first, we have to introduce this topic, which is overtrading. So in a line or two, we have to explain what overtrading is. So this is how you should be starting. So I'm just starting, right? So overtrading is a situation where there is a significant increase in the sales of a company without sufficient backing up of resources required to support that level of sales. Overtrading is not good for any business, because if the company does not have sufficient resources to support a level of sales, then it will get into trouble once it has to pay back to its creditors, and it may end up with bankruptcy. Therefore, it's important for every business to evaluate and check regularly whether it's overtrading or not. One of the symptoms of overtrading is a significant increase in sales without a matching increase in capital employed figure. In Gorva company's case, the sales have increased by 40%, whereas the increase in the capital employed is significantly lower than 40%, and this has been suggested by the asset turnover ratio, which has increased from 1.94 to 2.52 times. Another symptom of overtrading is the fall in its current and quick ratios. In Gorva company's case, its current ratio has decreased from 1.28 times to 1.15 times and 0.61 times to 0.58 times respectively. Another symptom of overtrading is the fall in operating profit margin, and it is usually because of offering discounts to customers to attract more sales. In Gorva company's case, the operating profit margin has decreased from 11% to 8%. One of the symptoms of overtrading is the increase in sales to working capital ratio. In case of Gorva company, the sales to working capital ratio has increased from 26.73 to 30.53%, 30.53 times. So this is again a sign of overtrading, as this suggests that the company hasn't invested enough in its working capital to support its additional sales. In an attempt to increase the sales, the company may have a generous credit policy, and which will result in higher receivable days. And this is the case with Gorva company, where its receivable days have increased from 30 to 45 days. And this may put the company in trouble whenever it will be needing cash. The payable days, again, it has increased from 31 to 50 days, which is another sign of the payable, the overtrading. Then comes the inventory days. The inventory days have increased from 37 to 49 days. Again, there is an increase in inventory days, which suggests that the Gorva company is overtrading. Now, last is the increase in overdraft, which we did not calculate. Overdraft increase. So let's go to the question and see how much has the overdraft increased. So how much was the overdraft? It was 1600 in 2006, and now it has increased to 3225. So 3225, whereas it was 1600 minus 1. And just change the format to percentage. The overdraft has increased by 101.56%. Now comes the conclusion. The conclusion will be that the majority or all the symptoms of overtrading are present in case of Gorva company. So we can say with surety that Gorva company is overtrading. This is how we should be writing in the exam. So all what we did here should be shown in the workings. Don't show it on the face of the solution. So what you have to do is you have to keep it in the working section. So just take it here and start discussing here and refer to all those figures during your discussion. So let me take them back. So that's it. That was Gorva company. So now let me take your questions. So if you have any questions, ask your questions. I'm just giving you 3 minutes for question and answers. Well, Adam, yes, you are right. You can also increase the long-term capital increase to compare with sales. Yep. So sometimes they take working capital as current assets minus current liabilities, and sometimes uh, total assets minus current liabilities, net assets. What is the difference? No. Capital employed is always equal to total assets minus current liability, whereas working capital is always equal to current assets minus current liabilities. If someone subtracts current liabilities from total assets and still call it capital employed, it's wrong. How is the increase in inventory days symptom of overtrading? No, Hafiz Osama Saeed, please hold your questions. Let me first answer the questions that have already been asked, and then I'll come back to your new questions. Because when you keep on asking, the previous questions go out of screen. How is the increase in inventory days symptom of overtrading? Osama, when alone increase in inventory days will never be considered as symptom of overtrading. But if you combine the overall situation of overtrading, then it is one of the symptoms. Now, how is it one of the symptoms? In order to increase your sales significantly, you need to have inventory. So in the anticipation that the sales of the company will be increasing, what the company does is it starts piling up inventory so that it can sell more. So by producing more and buying more raw material, it piles up its inventory. And by piling up the inventory, it slows down the turnover and it increases the inventory days in return. Right? Okay. There's a question how I have calculated the sales growth. Here we go. Current year sales divided by the previous year sales and then -1 and then change the format to percentage. Daniel asks that, sir, can we calculate on 5 ratios, 1 mark for calculation? Well, not necessarily that we have to calculate all the ratios, but it's a good practice to look at from every aspect so that we are sure that the company is over trading. Now, Athar is saying that, sir, what if half of the ratios fulfill the conditions of over trading and the other are not fulfilling? I don't think the examiner will put you in such trouble. You will always have a clear direction of whether the company is over trading or not. So the objective of giving this type of question is to test your concept rather than uh, uh, putting you in confusion. So there will be clear indications. You may see 1 or 2 ratios that are not suggesting whether the company is overtrading, but majority of them will either be suggesting that the overtrading is there, or they will be suggesting that the company is not overtrading. Okay, because I could not attend yesterday's class. Okay. Uh, because I could not attend this question might sound stupid, but if you could tell if the business is relatively new, the sales would be increasing significantly, but the assets would be newer. So company won't be investing heavily in assets. So what should we do in this scenario? Kutsia, a very good question. If the company is new and it was just the second year of the business, and the existing assets, the company may feel that the existing assets are sufficient to support the sales, so there will be no significant increase in say assets as compared to the sales. And what should we be doing in this case? How will we be reaching to a conclusion whether the company is overtrading or not? I hope this is your question, right? Okay, in that case, industry averages will be very useful. You have to see what is the sales to working capital ratio, what is the sales to capital employed ratio, what is the turnover ratios. So looking at the industry averages, you will get an idea whether the company is currently overtrading or not. Because in this case, simply comparing with the last year will not give us sufficient information of overtrading. So industry averages will help us reach to this conclusion. So we have Ajmal's question. If we ask to solve this question in words, so this question will be very time consuming. Can we solve part of this question in words and part in an Excel, or both in Excel? Well, you will not have the liberty to choose between the workspace. The workspace for one particular part will either be the word play in the form of a word space, or it will either be in the form of a spreadsheet. So you will not have the liberty to choose. So it will be the examiner that will be giving you whether you should be solving it on spreadsheet or on the word space. Increase in assets turnover ratio is 29% from 1.94 to 2. Isn't that a high increase as compared to increase in sales? Asset turnover ratio, remember the asset turn ratio does include the sales figure. So you don't have to compare it with the sales growth. That is sufficient to tell you that the sales have increased significantly, but the assets haven't increased, because when we are calculating the asset turnover, we use the sales figure. Already we are using the sales figure. So never ever compare it with the sales growth figure. So guys, we are done with this. I hope it's clear now. Now there is a question called PNP question. Tomorrow I will share a video lecture on this PNP question. It is related to the receivable management, which we have already solved. So I will be adding a video lecture on the Google Classroom, so you can access that lecture tomorrow from your Google Classroom, which will be solving this question. But before I post the video, try this question yourself and see if you can solve the question. But the video is going to come tomorrow. Then comes this FLG Quest company. This is again your assignment. So solve it, and I will also be posting the video for this assignment. I was supposed to give you this assignment yesterday, but I somehow, I think, forgot to give you this assignment yesterday. Okay, so now let's move towards investment appraisal. I have uploaded the investment appraisal worksheet in your day 2 folder on Google Classroom. So you'll find this worksheet there. Kutsia, yes, ACCA will be sharing the lecture with you on Vimeo Pakistan channel, Vimeo ACCA Pakistan channel. Okay, now let's start investment appraisal. Well, before we start practicing questions, I will be just giving you a quick uh, concept of present value, because without a concept of present value, if you go on solving the net present value, calculating net present value and other stuff, you may be good in calculation stuff, but you will never be able to explain what you are doing. So let's quickly discuss the concept of present value, and I want you people to hold your questions for a while. Javeria, just hold your questions. I will guide you how you can join the Google Classroom. So for the time being, I want you all to hold your questions and concentrate on present value concept. It's a very good concept, and I hope that you will enjoy this concept. So just, I want you people to concentrate. What is the concept of present value? Just look at it. Let's say you have an investment opportunity. You have an investment opportunity, right? And the investment opportunity is that you have to invest today. We don't know how much, but you have to invest a certain amount today, right? And you have been told that you will receive $11,000 cash inflows, that you'll receive $11,000 cash inflows, $11,000, and this you will be receiving after year one, right? So after year one, you will be receiving $11,000 from this investment. And today you have to invest a certain figure. What that figure is, we don't know. So we're just leaving it for a while. Okay. Now you have to decide how much you should be investing today against the $11,000 that you're going to get after year one. And this is the total, by the way. This is the total amount that you'll be getting from this investment. That's it. It's a 1 year investment. Okay. Now, how much you should be investing today will totally depend on how much you want to earn, right? Your required return. So you have to decide how much you want to earn. Let's say the company wants to earn 10% per year, right? So 10% of what? 10% of its investment. Now, in a 1 year's time, the company will be receiving $11,000. It needs a 10% return on its investment. And now it has to decide how much it should invest to get this 10% return. So how we are going to calculate the amount of investment? So the investment amount, we don't know what the investment amount will be, but we want to invest, just look at it. We want to invest X amount, right? We want to invest X amount, and after 1 year, we want to receive this X, the amount that we have invested, plus we also want 10% of this amount as a return, 10% of X. So X plus 10% of X, this is what we want after 1 year. But after 1 year, what are we getting? We are getting 11,000. So we want this $11,000 to be equal to our investment plus 10% of an investment, right? So we have to solve this equation for the value of X. The X is basically the amount that we should be investing. So just quickly go ahead and solve this equation for X. 10% means 0.1, right? 10% means 0.1X. So quickly, I want you people to solve it for X. The X is basically the answer to the question that how much maximum we should be investing in this project. So I need answer from each one of you. Quick, everyone should answer. I'm waiting for your answer. Good. So basically, if there is nothing with the X, it means it's 1. 1 plus 0.1. This whole thing will become 1.1x. And this 1.1x is going to be divided here to find out the X. So if we divide 11,000 by 1.1, we will get the answer. That means that we should be investing $10,000 in this project today. And after 1 year, when we will be receiving $10,000, sorry, we will be receiving $11,000, we will basically be able to cover the $10,000 that we invested, and 10% of the 10,000, 10% of the 10,000 will be 1,000. So 11,000. So tell me, should we be investing more than 10,000 for this project? No. This is the maximum that we should be investing if we need 10% return. Maximum that we should be investing in the project, right? So we have now the maximum investment in our mind, right? Okay. Now, how else we can calculate this 10,000? We have a formula called formula for present value of cash inflow. We can use that formula to calculate the same, right? So we need cash inflow, which we denote by S. We need the rate, the return, and raised to the power minus N, that is the number of years after which we are going to receive this cash inflow. So S in this case, what is S in this case? The cash inflow, right? And what was the cash inflow figure? 11,000. Okay. Okay, what is the rate of return? It's 10%. After how many years we are going to receive 11,000? After 1 year, so minus 1. Here we go, we have got the answer. That's a present value. So it means present value is basically the maximum investment for a given cash inflow. So we can say maximum investment can be defined as the present value, or present value of any cash inflow will be defined as the maximum investment for that cash flow. That's the concept of the present value. So present value is basically the maximum that one should invest in a project if it requires a certain return. Right? That's what the concept of present value is. So whenever you calculate present value, it means you have calculated the maximum investment that you should be willing or you should be investing for a given cash inflow. Okay, so now we have found that what maximum we should be investing. Let's now get back to the example, and let's assume that the person who's asking for this investment requires you to invest $10,500 in this project. $10,500 in this project. Should we invest or not? No. Okay, what if we invest? Basically, you know what we will be doing? We will be investing $10,500 for a project for which we should be investing 10,000. So basically we will be investing $500 more than what we should be investing, and it's never advisable to do so, right? So it's negative. Now what is this figure called? Now the 10,000, what was the $10,000 called? It was present value of cash inflow, right? It was the present value of cash inflow. So we just picked up the present value of cash inflow, that is the maximum we should be investing. And from this, we subtracted the required investment, the initial investment, or we call it the present value of cash outflow. Right? So from $10,000, that is the maximum we should be investing, we deducted the required investment and we got this minus 500 figure. This figure is net of two present values. That's why we call it net present value. And that's why when it is negative, we should never be investing in a project, in such a project. This figure is net of two present values. And that's why when it is negative, we should never accept this project. This is the concept of net present value. Is it clear? Which part do you want me to repeat, Abdurrahman? Just quickly, which part do you want me to repeat? If you can just quickly come up with a question. Which part should I repeat? $10,500. I just assumed this figure. I just assumed that, let's say, the person who is willing to give you $11,000 in 1 year's time asks you to invest 10,500, and we decided that we should not be investing more than 10,000. And then we just took the difference between the two to see whether the person is asking for more or less. So definitely we should not be investing more than $10,000, whereas the investment requires us to invest $10,500. Is it clear? Yes, yes. Shaliha, I will be moving toward discount factor. For the time being, I'm just explaining the concept of the present value. Then I will move on towards the discount factor. It gives us the same answer. So now let me give you a quick recap, and then we will move towards the net present value questions, right? So I've just assumed this example. In this example, I've assumed that the investment required today is 10,500. Against this 10,500 investment, the project will give us $11,000 in 1 year's time. We need a return of 10%. So against the $11,000, we just calculated the figure what we should be investing, and the figure was $10,000. If we invest $10,000 and then we get 11,000 in 1 year's time, it would mean that we have earned 10% in addition to what we have invested. So the maximum that we should be investing will be $10,000, and that is called present value. From this $10,000 will now be compared with the required investment of 10,500. The project requires us to invest 10,500, whereas we believe that we should not be investing more than $10,000. Therefore, we should reject the project, as the project requires us to invest 500 more than we should be investing. Okay. Now, we use this formula to calculate present value. Now I'm going to show you an alternative approach of calculating the present value, which is a simpler approach, and that is using discount factor. What is discount factor? Let me tell you. In this example, we calculated present value of $11,000 that we were receiving in 1 year's time, right? After 1 year's time, we were receiving 11,000, and we wanted to know how much we should be investing today against the $11,000. Now, instead of using 11,000 cash inflow, what if I say that the project is only going to give us $1 after 1 year time? Suppose that a project is giving us $1 instead of $11,000 in 1 year's time. And now I want to find out how much should I be investing for $1 today so that I get 10% return. So I'm just putting 10% here so that you should know what I'm using as a discount rate, 10%. Okay, and I'm getting it after 1 year. This $1 I'm getting after 1 year. So first of all, mathematically, just quickly tell me, should I be writing 1 or I should ignore 1? Because 1 multiplied by anything will give you the same answer, right? So it won't make any difference whether I write 1 or I don't write 1. So I'm just removing 1 from here, right? There will be no difference to the answer. Now, if I press enter, I will get what I should be investing maximum for $1. It's $0.909. So if you are going to receive $1 in 1 year's time, you should not invest more than $0.909 today if you really want to earn a 10% return. You should not invest more than this 0.909. And this 0.909 is called discount factor. Discount factor. You can call it as a present value of $1, PV of $1, or you can call it discount factor, 0.909. You should not be investing more than $0.909 for $1. This is if you receive it after 1 year, right? So if you know that you should not be investing more than 0.909, or you should be investing maximum 0.909 for $1, then it's very easy to calculate the present value of $11,000. If the value of $1 is 0.909, then what should be the value of $11,000? 10,000. We know the value of $1. We need to find out the value of $11,000. All we have to do is to multiply this with 0.909. We will get the same $10,000 answer which we got previously. So discount factor table is usually available in the software. But when I'll be moving towards the NPV question, a comprehensive NPV question, I will show you a very easy way of calculating discount factors. But remember the formula for discount factor. The formula for discount factor is 1 plus R 1 plus R raised to the power minus N. That's the formula for calculating discount factor. Yes, using spreadsheet, it will be too easy. The approach that I'm going to teach you in a while will be very easy. It won't take time. Even if you have a 5-year project or 6-year project, it will just take few seconds to calculate these discount factors for all of the years, right? So I hope that the concept of present value is now clear. The present value of any project is basically the maximum we should be investing for a project. Let's move towards a comprehensive question of investment appraisal. So let me zoom the question and let's read the question. PV company is evaluating an investment proposal to manufacture product W33, which has performed well in test marketing trials. Recently detected flana. So the following information relating to this investment proposal has now been prepared. Initial investment, that is required investment, is $2 million. So the $2 million is what is required for this project. So this is something that we will be considering at the end. First, we need to find out how much we should be investing for the project. That is called the present value. Okay, the price is $20 per unit, and there is a phrase written current price terms I will be explaining in a while. The inflation is 3% per year. That is the price of this price will be increasing by 3% every year. Variable operating costs 8%. Fixed operating cost 170,000 per year. Expected operating cost inflation 4% per year. Okay. The research and development division has prepared the following demand forecast as a result of the test trials, and it's a 4-year project. Okay, and the demand for each of these 4 years have been given. It is expected that all units of productivity which produced will be sold. Okay, there will be no inventory, no terminal value or machinery, that is no scrap value at the end of the 4 years. Okay, for investment appraisal purpose, PV uses nominal money discounted of 10%, and we don't need this 30% for the time being. Let it be. Okay, so what we need to do is we have to calculate the present value. Okay, present value basically is the maximum we should be investing for this project. So let's calculate the present value, and let me zoom it out again so that I can easily calculate. Okay, so first of all, let's start with sales figure. Now in the investment appraisal, so whatever I say, just note it down. Okay, the first assumption which we usually take in investment appraisal question is that all the operating cash flows or all the cash flows will be occurring at the end of a year, whether it's sales or it's operating expenses, except for the things that are mentioned otherwise. Right? So all the sales figures, the variable cost figures, and the fixed cost figures will be assumed that they will be occurring at the end of the year. So 0 means the start of the year, the start of the project date. It's basically the first day of the project, that is now. So I'm just ignoring this because we will be assuming that the sales of the first year will be at the end of the first year. Okay, what is the sales demand for the first year? Quickly, it's 60,000. We should write only 60, right? What's the price? 20. But there is a phrase mentioned with the price, right? Current price terms. This current price term means that this product, if sold today, will be sold for $20 per unit. But we are assuming that all the sales will be made at the end of the first year. Though practically the sales will be made throughout the year, but we cannot do calculation for 365 days of a year. So we either have to assume that all the sales are occurring at the start of the year, which is very irrational to assume. It's better to assume that the sales will be occurring at the end of the year. So after the end of the year, the first year, we don't expect this price to be $20 if there is inflation. So there will be a 3% increase in this price. So what we will do is just look at this. I'm using a shortcut into 1 plus 3%. Okay, and then I'm just taking the power raised to the power 1 here. I've already written here 1. So instead of putting 1 here, I just referred it to this cell, because when I'll copy this formula to the next cell, this K9 will automatically be converted into L9, that is 2. Then it will be converted to 3, and it will be converted to 4. So we will be increasing it this way. So let me press enter. It will automatically increase the price by 3%. And here we go, it's 1236. And now let me copy this formula and paste it in these 3 cells. Now I only need to change the volume, the sales volume figure, which is different in every year. The rest of the things should not be changed. The 20 price should be the same. The 3% inflation should be same. Now look, if you can just look at it, it's L9 now, L, and it's 9, 2. So it will increase this price of today for 2 years. for 2 years. It will automatically increase it for 2 years. So let's just change the sales volume now. 60. Instead of writing 60, we should write 70. Right? We should just change this 60 into 70, and we do not need to change anything else. Everything else is being placed correctly. 1485. Let's move towards the next cell and just change the sales volume. Don't change anything else. Just put it 120. And now let's move towards the last year, and it's 45,000. So just make it 45. No need to change anything else. That's the quickest way of doing it. So I will be saving this file for your review later on after the session. I'll be uploading it to the Google Classroom. So don't worry if you don't remember the formula. I've just written it here, and I'll be sharing this file with you on the Google Classroom. Then comes the variable cost. It will be calculated in the same way. So for my ease, okay, let's derive a formula for the variable cost now. Just since variable cost should be a negative figure, so I'm just starting with a minus sign here, right? With a minus sign. And let me write the sales volume 60 into the variable costs. Again, the variable cost figure is in current price term. That is, it will cost us $8 today, and we have to inflate it right from the very first year. So 8 into 1 plus the cost inflation rate, which is 4%. 4% raised to the power 1. 499. And let me copy paste here. And again, now I just need to change the sales volume. That's it. Instead of 60, I should write 70. Instead of 60, should be writing 120 for the next year. And then 45 for the last year. 421. Yes, Kutsia, we can do that as well. But it's better to keep it as simple as possible so the examiner can easily check your working. Now in this case, examiner can easily check all of my workings. I don't need to show any separate working. So the answer is here, the working is here. So if the examiner wants to check the answer, right in front of the examiner, answers are there. And if he wants to check the solution, you just have to double click to see the working behind. Okay, now let us subtract the fixed cost as well. The fixed cost per year is $170,000, and again, it's in current price terms. It's in current price terms, which means that the fixed cost today will be $170,000. But since we are assuming that all the costs will be incurred at the end of the first year, so we have to inflate this figure as well. So 170,000 into 1 plus cost inflation rate, which is 4%, raised to the power 1. And let's copy it here. So here we go. In less than a couple of seconds, I have calculated the fixed cost for all the years. I have applied the degree of precision here. I haven't used these figures in thousands. I've just written 60 instead of 60,000 because I've put 3 zeros on the top. So I've applied the degree of precision. Jonathan? Okay, now I don't think we have any other operating costs, so we should. Yes, we need incremental fixed cost. These $170,000 are the incremental fixed cost. Nowhere it has mentioned. Look at this. The following information relating to this investment proposal. So it has clearly said that it's related to this investment proposal. So we should assume that these $170,000 are the incremental ones. These are the result of this project, as it has been mentioned here, right? Okay, let's now net off these figures. So I'll just use the sum formula and we'll select these three cells, 560. Okay, we got pre-tax cash flows. So we need to check whether we have tax given in the question. If not, then it will be much easier. Yes, we have. They've asked us to ignore taxation. So for this question, we will be ignoring taxation. So it's a very simple question. So ignoring the inflation. So we've got the pre-tax cash flows, or we can now call it the net cash flows, as there are no other cash flows for the year. So we can call them net cash flows. Now these are the cash flow that we will be receiving after every year. Now against these cash flows, we have to decide how much we should be investing at maximum, at max. So for that, we need discount factors, right? So what is the cost of capital, the required return? The minimum required return is 10%, okay? So now it's the time I'll tell you how we can quickly calculate the discount factors for each of the 3 years. Okay, so just watch it carefully. Is equal to 1 plus 10% raised to the power minus, and refer it to this one again, right? So here we go. We have 0.909 here, and all we need to do is to copy, Control C, select these three cells and press Control V. So we've got all the discount factors for the 4 years. We don't need to look at any table. We don't need to calculate it separately for every year. Is it clear? 1 plus 10% raised to the power, refer it to this row. It will automatically change the numbers for the rest of the years. Okay, now 560 multiplied by the discount factor. Here we go, we have got the present values. For 560 net cash flow, we should not invest more than 509. So for this 560, we should be investing maximum of $509. For these cash flows, we should be investing 575. For these one, we should be investing 1015 today, and for these ones, we should be investing 268. For the whole project, what should we be investing? Let's add them together. Present value of cash inflows. That's the maximum we should be investing. So let's sum all these. 2368. This is what we should be investing at max. Now let's calculate the net present value. How much is required by the project? What is the project asking us to invest? How much? 2 million, right? So this is what we think we should be investing, and this is what the project is asking us to invest. So it's 368,000 US dollars that we should be investing. So this is sorry, $368 is the net present value. Sorry. So what do you people think? What should be the comment? Should we accept or not? Yes, since the net present value of the project is positive, we should invest. That's it. Yes, there is a formula for NPV, but I would not suggest you to use that formula. It's better to use this one, because that formula is by no means simpler than this. So it will take you the same time, but this is a better way of calculating it, because this will help you interpret as well. You can use this present value of cash inflow figure later on as well. Yes, I can repeat. Just look at it. Is equal to 1 plus the discount rate, the 10%, bracket closed, power minus, refer it to this 1. enter 0.909, then copy it to the rest of the cells, and here you go. Is it clear, Christine? Okay. And I'm sorry if I do not pronounce the name of anyone correctly. Just press Control C here, and then select the cells in which you want to paste. Select these 3 cells and press Control V. Okay, so we are done with the invest and net present value. Now let's calculate the IRR. IRR. Okay. First of all, I need to ask you a few quick questions before I go to IRR concept, right? Tell me, what do you think? Are we getting more than 10% return from this project, equal to 10%, or less than 10%? Everyone. Are we getting more than 10% return, right? Yeah, more than 10%. And that's why we are accepting it, because our cost of capital, that is our investors ask, the people who have invested in our company are looking for 10% return. And this project with positive NPV is telling us that this project is giving us more than 10%. That's why we are accepting it, because we will be in a position to satisfy our investors, and not only satisfying them, but we will also be able to save something for our company for reinvestment purpose. So we are getting more than 10% because the NPV is positive, right? Okay. Now quick questions, and you will understand the concept of IRR. Okay, quick questions. Tell me, if I solve this question again and I start using a higher a higher rate of discount rate, let's say 11%. Okay, 11%, and I calculate the NPV and it's still positive. What do you think? Am I getting more than 11% as well? Right? I'm getting more than 11% from this. Yeah, I'm getting more than 11% because I still have a positive NPV. Okay, what if I change it and I change it to 13%? Okay, let me change it significantly, 15%. Okay, now I've used 15%. So am I getting more than 15%? Yes, I'm getting more than 15%. So it means even if my cost of capital is 15%, I should accept this project. Even if my shareholders are demanding more than 15%, are demanding 15%, I should still accept this project because this is giving me more than 15%, right? Okay, so I'm just checking, right? I'm just checking that to what extent I can afford my cost of capital to go up. So I can afford a higher cost of capital than 10%. I can afford 15% as well because this project is giving me more than 15%. Okay, let me make it 20%. Here we go. It's negative now. So tell me, can I afford a 20% cost of capital? No. If my cost of capital is 20%, I should not accept this project because now it's negative. Okay, let's reduce it to 18% and see what happens. Okay, at 18%, it's just $1 negative, just one, right? So can I say I am earning approximately 18%? Can we say that we are earning at approximately 18% because at 18% cost of capital, we won't be able to save anything. So I'm just earning 18%. So if the cost of capital is 18%, the company is not going to save anything. It means that we are getting 18% return. And if we pay 18% to our investors, we pay back 18% to our investors, we will only be left with, we won't be left with anything. That 18% is the IRR of the company, the rate at which we will be getting a zero NPV. It means that we cannot afford to have more than 18% cost of capital. The maximum cost that we can afford is the maximum return that we are getting from the project. Right? So what we need to do is we need to find out this particular rate at which the NPV is going to be zero. Right? We need to calculate this rate. Now the formula for calculating the rate at which NPV will be zero, basically this is going to tell us the maximum cost of capital we can afford. Yes, IRR shows that what is the return that the project is generating, so that we can compare it with the cost of capital and see how much we are going to pay back to our investors and how much we are getting from the project. We will only accept the project if we are getting more from the project and paying less to our investors. So IRR is another investment appraisal technique which tells us whether we should be accepting a project or not. So let's calculate IRR of this project. So the formula of the IRR is A% plus capital A divided by capital A minus B, and then this should be multiplied by B% minus A%. Okay, now what is these variables? A% is basically the lower rate. We need two rates, so one rate will be the lower and the other will be the higher. So A% is basically the lower rate, B% is the higher rate, capital A is the NPV at lower rate, and B is the NPV at higher rate. Okay. In this case, we already have a positive NPV, that is 363, right? So we can say 10% is our lower rate because this NPV has been calculated using 10%. This is our lower rate, and the NPV that we have received will be considered as the A, capital A. But we don't have the higher rate and the NPV. So we have to assume another rate which will give us a negative NPV, right? This should be the practice of IRR. So we don't know what that rate is. So we should be taking a huge gap so that the NPV is confirmed negative. So I'm just taking 20%, which because we just did it a while ago, and at 20% it was negative, right? Here we go, it's negative. So how will we know that at this rate it will be NPV? It is going to be learned through practice. So the more you practice, the more you will know that how much gap you should keep in the lower and the higher rate so that the NPV becomes negative. So we have got 79, sorry, it was 366 earlier, and now it's 79 negative. Okay, and the higher rate in this case is 20%. Okay, now let's put these values in the formula and we will get a rate close to 18% that we just calculated above. So let's do it now. The A%, which is this 10%, plus the capital A, which is 366, divided by the sum of the positive NPV 366 and this one. Okay, now close the bracket, multiply it with the difference of these two rates, 20 minus 10, and just change it 18%, right? That's IRR. So with the help of this formula, we have directly calculated the rate at which the NPV is going to be 0. The next step is to compare with cost of capital. What is the cost of capital? How much we have to pay to our investors? 10%, right? So if we are supposed to pay 10% to our investors and their money will be invested in a project that is giving us 18%, don't you think it's a project to undertake? So the decision rule will be except if IRR is greater than cost of capital, otherwise reject. Why you have not done the separate working of calculation of NPV? Do I really need to? If I could do it without additional calculation, why should I be putting myself in trouble? You should not be doing it in the exams because the NPV figure has changed. So in the exams, what you need to do is, okay, let me show you how you will be doing in the exams. Okay, let me show you how you'll be doing in the exams. Okay, you did this. Okay, all you need to do is just copy this part of the question. Okay, just copy this part, take it down. I'm just showing you how you should be doing it in the exams. Put it down. Okay, just keep it at the 10% which we did earlier. Okay, and use 20% for this part and calculate NPV. Here we go. So rate is 20%. Okay. Now solve it for IRR. That's it. Yes, Adam, you can use any Excel formula, any spreadsheet formula. It is allowed to use it. That's why spreadsheet is there. But in the exams, the formula hints are not given. Like for example, if I write IRR here, right? If I write IRR here in Excel, you can see it's giving me the hint that for what values you want to calculate IRR and what's your guess rates. But in your exams, when you write IRR, there will be no hint available. You won't see the hints. So if you remember the complete formula of the complete structure of the formula, only use the formulas then. Otherwise, it's better not to use the formulas because you may make a mistake. Okay, let's take a 5 minutes break. Let's take a 5 minutes break. Yeah, I'm taking 5 minutes break. Just take a rest. And if there are any other questions that I can answer meanwhile, you can ask me questions. But for others, they can take a break. Athar, you don't need to show any separate working. The cell formula is enough to show the working for the examiner. If you have to show another working, what is the point? What's the point of using spreadsheet? Yes, you can use discounting factor tables as well. Okay, let me go through the questions. Sorry, I was doing something. Sir, I'm not getting the Chandni, what were you saying? I'm not getting NPV. Can you just can you just explain your question further? Then if I'm you will be added to WhatsApp group. You'll A link of WhatsApp group will be shared in the chat box in a while. Just use that. Otherwise, I will share my contact number with all of you. You can text me on the WhatsApp as well. I will add you to the group. Okay, then Abdul Reza says that, sir, will you tell about Scratchpad usage because I'm not used to. Well, for the Scratchpad, I have a better suggestion for Scratchpad. What you all should do is definitely you will not be using this Scratchpad for the spreadsheet based questions because on the spreadsheet you don't need anything else. So it will be enough. But for the MCQs part, definitely if you have to make complex calculations, the Scratchpad will be difficult to use. So you know what? You should find out a question of spreadsheet in your paper. And what you need to do is just go to that spreadsheet part, solve the question on the spreadsheet, take out the answer, and just go to the MCQ and click on the right answer. So use the spreadsheet of any other question for solving the MCQ part as well. This is what you can do. Did you get it, Abdul? Sir, I am a bit confused. If we don't show the separate working of calculation of negative NPV, then how should examiner come to know about Athar? I did the separate one, right? Now I think I have answered your question. I have just copy pasted all the figures and I've calculated a separate NPV again. Abdul Mueed, yes, we should be adding the scrap value at the end of the project if it was there. Hamza sir, Ijaz questions कहाँ पढ़ रहे हैं आप? मतलब I didn't get it. What does this mean? When commenting on IRR, is it sufficient to just write that it's acceptable if higher than cost of capital? Yes, in the investment appraisal part, when you have to comment on the acceptability of a project, it should be a one-liner no comment that whether we should be accepting a project or not. I'm not getting the right NPV. I got a different figure. At which rate? Solve IRR by direct formula in Excel. Okay. Abdurrahman says, sir, आप इसको directly solve. Okay, I'll just solve it directly. Okay, here we go. If you need to apply the IRR formula directly, just go to IRR. Okay, select the values. But since we haven't written the cash in the investment, we should write the investment as well. Just write IRR. Select all the values, including the negative NPV. Okay, and close the brackets. The guess rate is optional, whether you want to put it there. Otherwise, it's not required. So here we go, 18%. Yes, Abdul Reza, you can simply you can copy the question and solve it and then use the answer. Ajmal, yes, all these questions are from past papers. So why we are not taking minus n, the formula of sales? Why should we be taking minus n? We are not going backwards, we are going forward, Raza. We have to increase. We have to increase the value. We don't have to decrease the value. Which formula? For the IRR formula? Why do you think it's not enough? It's good. You can use this formula. But I will always suggest that do the calculation in spreadsheet. I don't think it's too difficult to do it. Yeah, you just need to copy it, that like I did it. Just copy paste and just use another rate. So I don't think it will be difficult to do all the calculation. He must give you, he must give you, but better not to use. I would suggest not to use, because if you make a small mistake, you won't be able to trace it. So better to copy paste all what you have already done. It won't take a lot of time. Just copy paste this, use a different discount rate and apply the IRR formula. Better to do that. Well, for all questions related to what is allowed in the exams or what is not, I would suggest you to go to ACCA's website, where they have given the whole list of FAQs for remote exams. Okay, now I think we had enough break. We should move forward. So let's go to the next question, the AGD question. Now, again, it's an important question. It's the lease or buy question. Okay, for all other questions, we can use WhatsApp, right? So let's move forward so that we can complete our questions of today easily without any fast pace. Okay, so lease or buy. Just now, I want you to note down the important things that I'm going to discuss, which will help you in a question of lease or buy. So first, let me discuss a theoretical part of lease or buy decision, what this decision is. Yeah, okay. Lease or buy. First thing, it's a financing decision, not investing decision. This is the first thing that you should note. In the investing decision, we decide whether we should invest in a project or invest in buying a particular equipment or machinery or not. Whereas in the financing decision, we do not decide whether we should be acquiring a particular machinery. The only thing that we are going to decide is to decide between the modes of financing. Either we should buy it outright by paying outright, that is, we make a cash payment and buy the asset, or we should acquire the asset through a lease option. So this is called financing option. This is called financing option. So okay, financing decision. Now, in a financing decision, remember one thing: which cash flows we should be considering. Which cash flows we should be considering. In financing cash flows, we should be considering financing cash flows. Okay, what do we mean by this? Financing cash flows, those cash flows that will change with the financing decision. Meaning that if we choose to buy the asset outright, it will cost us differently. And if we choose to lease the asset, the cash flows will be different. So whatever cash flows differ between the two options are called financing cash flows. Now, I will ask you questions. I will ask you questions and you have to respond, okay? So tell me, will the initial investment figure change with the change in financing options? The initial investment figure is obviously going to change, because if you are buying the asset outright, you have to make the whole payment. You have to make the complete payment today. Let's say, for example, if you are going to buy an asset which has a cost of 1 million, the whole 1 million will be paid today if you are buying it outrightly. But in case of a leasing, you don't have to pay the complete amount at point zero. So the initial investment figure will change. with the financing options, right? So initial investment is a financing cash flow. So these are financing cash flows. These are the cash flows we must consider while we are taking this decision of lease or buy. Initial investment. Okay. Scrap value. Do you really think the scrap value will be a relevant cash flow when we'll be choosing between two financing options? We must be considering scrap value because when we buy the asset, we own it. And when we will be selling the asset, we will be getting the scrap value. But when we acquire asset through lease option, we don't own the asset. Remember, we don't own the asset. So the scrap value belongs to the original owner, not to us. So we won't be getting the scrap value in that case, right? So scrap value is again a relevant cash flow in lease or buy decision. So we must consider scrap value. It must appear in one option and it will not appear in the lease option. Okay, next, tax benefits on capital allowance. Is it relevant? Yes, it is relevant because you will only be allowed capital allowance if you are the legal owner of the asset. And you can only be the legal owner of the asset when you buy the asset rather than you lease the asset. So in case of a lease, you will never ever be given tax benefits on capital allowance because you don't own the asset, right? So it's a relevant cash flows. Okay, tax benefit, sorry, lease rentals, will these be relevant? Yes, because you don't have to pay lease rentals in case of buying option, but in case of lease option, you have to pay. So relevant cash flows. Okay, tax benefit on lease rentals. Lease rentals are allowable tax expenditures, so you will be getting a tax benefit. So tax benefits on lease rentals, are these relevant? Yes. Yes, these will be relevant because you are not going to get any benefit on lease rentals in case of buying the asset, because in case of buying the asset, you won't be paying any expense. So why you should be allowed any expense if you are not incurring it? So it will only be available when you are getting the asset on lease. Shafin, I'll just come back to this. I'll just come back to your question. Don't worry. This is what I will be discussing in a while. So tax benefit on lease rentals. Yes, they're relevant. Okay. What about maintenance cost? Will it be relevant or not? Okay. We can't have a simple yes or no answer for this. It depends. It depends. It will only be relevant if you have to pay this maintenance cost in one option and you don't have to pay it in another option. For example, for example, let's say you may get a question in which it says that it says that the maintenance cost will be borne by the owner of the asset. So in case of buying, you will be the owner, therefore you will be paying it. In case of leasing the asset, you won't be the owner, so you won't be paying for the maintenance cost. That means it is going to be relevant. But if it says that the maintenance cost will be borne by the user of the asset, then it will be irrelevant, because whether you take the asset on lease or you buy the asset outright, in both cases you will be using the asset, therefore you will be paying for the maintenance cost. So maintenance cost will be irrelevant in that case. So for any other expense, this is going to be the rule. If any cost is to be borne by the company irrespective of the option chosen, then it will be irrelevant because the cost won't change. But if one if a particular cost is borne by the company in one option but not in the other option, then it is always relevant. That's the simple rule, right? So let's solve the question now. Solve the question. AGD company is a profitable company which is considering the purchase of a machine costing 320,000. If purchased, AGD company would incur annual maintenance cost of $25,000. The machine would be used for 3 years, and at the end of this period would be sold for 50,000. Alternatively, the machine could be obtained under an operating lease or for an annual lease rental of 20,000 per year, payable in advance. And capital allowance will be available on 25% reducing balance basis. The company pays tax on profits at an annual rate of 30%, and all tax liabilities are paid 1 year in arrears. AGD company has an accounting year that ends on 31st December. Okay, if the machine is purchased, blah blah blah. Okay, let's first consider the buy option. So hold your questions. I will answer each and every question. First, let's focus on the question 0, 1, 2, and 3. But because of the text being in arrears, we have to stretch it to 4 years, though the machine is going to be there for 3 years, right? So because of the arrears, we are stretching it to 4 years. 1 year will be additional. This will be the case in every question where the tax is paid in arrears. Okay. First of all, the initial investment, okay, which is going to be 320,000. So I'm just writing the whole figure, 320,000. Okay. After initial investment, there will be scrap value, which will be received after the end of 3 years, and that is going to be $50,000. Okay, the initial investment figure should be a negative figure. Okay, let me change this to accounting format. Okay, scrap value, initial investment. Now comes the tax benefit on capital allowance. Okay, let me write it in the end. Let's first take maintenance cost. Okay, for maintenance cost, what I told you, that you should only consider maintenance cost as relevant when it is different for different options. So in one option you have to pay maintenance cost, and in the other option you don't have to pay. So in this question, it has only asked, it was only mentioned it in case of buying. Just look at the sentence. If purchased, AGD company would incur annual maintenance cost of $25,000. But nowhere it has mentioned that the company will be bearing the maintenance cost in case of leasing as well. So in case of buying, you have to pay maintenance cost. In case of leasing, you don't have to pay maintenance cost. So there is a difference, right? So whenever the cost is different in two options, that cost is relevant. So we must consider it. So $25,000 annual maintenance cost. So minus 25,000, and let's copy it here. So you have to pay this maintenance cost. Okay, will this maintenance cost be a tax allowable expenditure? Will the tax authorities allow this to be deducted from your taxable liability? Is a maintenance cost business expense? Quick, everyone. Maintenance cost is a tax allowable expenditure. It means that when your tax liability will be calculated, the tax authorities will deduct 25,000 from your income. In that case, your tax liability will be reduced. That is, you will be getting a tax benefit. So for example, I'm going to give you an example. Let's say your income before deducting the maintenance cost is 1 lakh. So what the tax authorities will do is they will just deduct 25,000 in the first year from your income of 1 lakh, and then they will tax you. Then they will apply this tax rate. So they will just apply the tax rate on the 75,000 figure and not on the 1 lakh figure. It means that whatever tax you were supposed to pay on $25,000, you won't be paying that. That's considered your tax saving. So is it going to be considered as your tax saving, right? So we must show tax benefit on maintenance cost. right? Now, the tax benefit of these $25,000 will be received in next year, as the tax is going to be paid in arrears. So the benefit will be received in the next year. Remember, in arrears, you have to show the benefit in the next column. So 25,000 into, what's the corporation tax rate? 30%. So we should take 30% of the $25,000. This is basically the reduction in our tax liability because of the maintenance cost, which is a benefit of the company, shown as a positive figure, 7,500. This will be for the first year, that will be received in the second year. For the second year, it will be received in the third year. So simply, I'll just copy this. So here we go. These are the tax benefits on maintenance cost. Now comes the tax benefit on capital allowance. Okay, it's a tricky thing. The tax benefit on capital allowance is a tricky thing. Therefore, firstly, I will, for the sake of explanation, I will use a lengthier way. And then I will show you a shortcut which you are going to use in your exams, right? So let's first take a longer way to do it. Capital allowance is basically the tax depreciation that the tax authorities allow a company to record as expense. Okay, it's a depreciation basically. So how much is allowed? Let's look at the question. 25% on a reducing balance basis. So how much depreciation each year will be allowed by the tax authorities? That's what we need to calculate. So I'm just calculating the capital allowance figure for every year, right? So what is the cost of the asset? Who's going to tell me? What's the cost of the asset? Zishan is asking that how do you know that the maintenance cost is allowable expense? Zishan, tell me, how do you know it's not the allowable expense? Just look at it this way. Usually it's a business expense. And how come a tax authorities can deny a business expense as our expense? We are paying a maintenance cost. How come they will not accept this as our expense? There is no reason to believe that they won't allow us. Okay, 320,000 is the cost of asset, right? So in the first year, okay, let me write it this way. Uh, the cost of the asset is 320,000. Okay, in the first year, the capital allowance will be 25% of the value of the asset, right? Of the value of the asset. It will be 80,000. So in the first year, the tax authorities will allow you 80,000 to be charged as expense, which means that whatever tax you were supposed to pay on these 80,000 will not be charged. So you will be getting a tax benefit of 30% on this amount. So we'll just take 30% of this amount, and this is your tax benefit. Okay, and this belongs to year 1 and will be received in year 2 because of arrears. So received in year 2. So the 24,000 will be the tax benefit for year 1, but because of the tax being paid in arrears, it will be received in year 2. So we'll have to show it in the year 2 column, right? This $24,000. Okay, let's go to the next year. So since it's a reducing balance method, so each year the 25% will be applied to the WDV, written down value of the asset. So for the second year, the WDV is going to be 240,000. So now the capital allowance will be 25% of the WDV, the remaining amount. So it is basically the tax authorities are going to allow $320,000 to be charged as expense over the 3 years life of the asset. Of the 320,000, they allowed 80,000 of expense in the first year. Still, there is 240,000 that has to be allowed in the coming years. So 240,000, we will take 25% of the 240,000, which is 60,000. So in the next year, they will allow us to charge expense of 60,000, and hence it will reduce our tax by 30%, which is 18,000. This is related to year 2, but received in year 3. So WDV for the third year will be 240,000 minus 60,000, 180,000. Now the third year is basically the last year of the asset. So in financial management, in the FM paper, we have to assume that in the last year, whatever value of the asset is left should be fully allowed by the tax authorities as expense. But if we are selling the asset, then this value must be reduced by the scrap value, because that is the amount that we will be getting back by selling the asset. So don't expect the tax authorities to be allowing you something that is not an expense, right? So the value that is left out of 320,000, which is not charged as an expense, is 180,000 for the third year. But since we will be selling this asset for how much? For 50,000. So we have to subtract the 50,000 figure from 180,000. The tax authorities will not allow you to charge the whole 180,000 as your expense. They will only allow 130,000 to be charged as an expense, and this is called balancing allowance. 130,000. This is the remaining value of the asset that you should be charging as your expense. And let me show it in a different way as well. The total asset, the value of the asset was 320,000, right? Of the 320,000, you will get your 50,000 back by selling the asset. So your net cost during these 3 years will be 270,000. So the tax authorities will only allow you $270,000 of expense to be charged against your income during the 3 years. Of this 70,000, you charge 80,000 in the first year, 60,000 in the second year. So 80 in the first year and 60,000 in the second year. So you have already charged 140,000 as expense out of 270,000. So what are we left with? What is the amount that the tax authorities will be allowing you? 270,000 minus 140,000. So just to explain, okay, you don't need to do this. So it will be 130,000 that will be allowed as an expense in the last year with the name of balancing allowance. And 30% of this will be your tax benefit. Now this belongs to third year, but received in fourth year, right? So the tax benefit that will be shown in year 2 column will be 24,000, then 18,000, then 39,000. But now this was just for 3 years, right? If the life of the asset was 5 years, it would have been a lengthy calculation. So let me show you a shortcut that you have to use in your exams for the reducing balance method. Look at this. So from where we are going to start? We are going to start from year 2. So year 2, just go to year 2. Okay. What's the cost of the asset? What is the cost of the asset? 320,000. Be active. 320,000. Okay. How much should be allowed as capital allowance? What percentage will be allowed as capital allowance? 25%. So I'm just writing 25%. And what is the tax rate? 30%. Okay. We've got 24,000 for the first year. Okay. Right. Just look at the shortcut. Just look at the shortcut. By how much will the value of the asset go down each year? 25%. And how much will be left? 75%. Right? So what you need to do is just take 75% of this first year figure. Because if the value of the asset is going down by 25%, automatically the tax benefit will go down by 25% for the next year. Here we go. It's 18,000. Don't need to go through this huge calculation. Just take 75% of the previous year and keep on doing this. Apply this 75% for every year. But don't do it for the last year. For the last year, there's another formula, because there we have to subtract the capital allowance as well. Oh, sorry, the scrap value as well, right? So just take 75%, you got the 18,000. Now for the last year, remember one thing. For the last year, what you have to do, just see the formula. What is the cost of the asset? 320,000. Okay, take the cost of the asset. Okay, and this value is going to be reduced at what rate? At 25% rate. So the leftover value will be 75%, right? So if I take 75% of this value once, it will give me the WDV after 1 year. If I take it twice, it will give me the WDV after 2 years. And if I take it as 3 times, it will give me the WDV after 3 years, but we don't need after 3 years. We need it for the 3rd year. So we have charged the depreciation twice. So we just need to take the power 2. When we take power 2 of 75%, just take the power as 2 because we have charged it twice. So just count these numbers. This will be the power 2. This will give us the WDV. This will give us the WDV figure. Okay, right? I'm just writing it. 180,000. See the WDV figure. Here we go. 180,000. From the WDV, we deducted the scrap value. So just go back to the formula and let's deduct the scrap value now. Minus 50,000. If we deduct 50,000, we will get 130,000, but that was not the tax benefit. This was the balancing allowance. Then we took 30% of this figure to get to 39,000. So let us close this into bracket and ultimately apply the tax rate. We will get 39,000. So if you have to calculate tax benefit on capital allowance on the basis of reducing balance, you can use this shortcut. In the first few years, just reduce it by the reducing balance percentage. And in the last year, you should be using this formula. Okay, so these are the tax benefits on capital allowance. So we don't have any other cash flow in case of buying the asset. So let's net it off, sum of the cash flows for each year. These are net cash flows. And now let's take discount factor. What was the discount factor? It's 7%. Remember, always take the borrowing rate for financing decision. If you are given, now note this point, this is important point. If you have the WACC, the cost of capital in the question, and you also have the borrowing rate, and you are taking a financing decision, never ever use the cost of capital, always use the borrowing rate. Note it down this. For a financing decision, you should always use the borrowing rate. But sir, what to do if we don't have the borrowing rate, we only have the cost of capital? Only in that case, we should be using the cost of capital. But as far as possible, we should be using the borrowing rate. Daniel, we have calculated the tax benefit on capital allowance. We haven't skipped it. We have used a simple way of doing it, right? If you skip a calculation and you just straight away wrote the answer, you will only lose marks then. If you have used a simple way of calculating something, that is never considered as skipping something. Borrowing rate is just the interest that you pay on a loan, whereas cost of capital is the average of the return that you are paying to both your investors through equity and investors through debts. Borrowing rate should always be the after tax borrowing rate. It should always be the after tax borrowing rate. It is already the after tax, so we don't need to do something. It should always be after tax. If the tax rate was 30% and this was before tax, we should have taken 70% of this figure. But in this case, we don't need to. It's already after tax. Okay, let's use that formula which I just taught you. 1 plus 7% raised to the power minus power. And we have got the discount factors of 7%. Now let's multiply the cash flows with the discount factors. We got the present values. And now let's calculate the NPV of the buying option. So sum it, okay, sum all. That's your NPV. So the cost of buying this asset is 260989. We should always take after tax borrowing rate, the post tax borrowing rate. Okay, so somebody has asked to show the formula I have applied in the cell. That's the formula. Okay, see, only ask me questions related to this part. If you have any other questions, when I'll give you a break for the questions, ask me other questions. Like Jahanzeb has asked me the tax exhaustion. So Jahanzeb, I'll get back to this later on. That's the formula for discount factor. Okay, so we've got the NPV of the buying option. Now let's move towards the lease option. At the end of the question, I will be at the end of this question, I will be taking your questions. Okay. Lease option. Okay. In the lease option, okay, let me remove this whole stuff because we don't need them anymore. So in the lease option, what are we supposed to be doing? We will be paying lease rental 120,000, which will be payable in advance. Okay, 120,000 payable in advance. Okay, and we won't be getting any scrap value, no maintenance cost. Then there will be tax benefits on the lease rentals. That's it. There are only two things. Okay, let's start. Okay, let's write year. I usually use a different format for lease options because we can use the annuity factor. Particulars, cash flows, discount factor or annuity factor, and PV. Okay, first of all, the lease rentals. The first lease rental will be paid from at year 0, that is in advance. And since it's a 3-year project, so there will be only 3 payments. So the first one will start from 0, the second one will be on 1, and then will be 2. So it will start from 0 and will end at 2. And we are talking about lease rentals. Okay, we are talking about lease rentals. And what's the lease rental amount? What is the lease rental amount? It's 120,000, right? So it's a negative figure, 120,000. Okay, since this will be paid every year for 3 years, so we can take a discount factor, right? Sorry, we can take annuity factor, which is the sum of the discount factors. So but this one starts from year 0. So is there someone who can tell me what will be the discount factor? What will be the discount factor for year 0? Anyone? It's always 1. So for that 0 payment, the discount factor is going to be 1. Okay. Then for the second year, here we go. We have this for the first year and we have this for the second year. So just pick up from there and add them. So 1 for the 0. So okay, we can also get the 1 from here as well. So we can just simply add these three, 0, 1, 2. So we've got the annuity factor now, 2.808. And now multiply 2.808 by 120,000 to get the present value of these $120,000, right? Okay. Then comes the lease rentals, the tax benefit on lease rentals. Now a very quick question. Tell me from where the tax benefits will start. Everyone, I'm looking for everyone's answer. From where will the tax benefits start? Remember, the tax benefits are going to be in arrears. Yes, from year 2, because what you are paying at point 0 belongs to year 1. Whatever lease rental you are paying at point 0 is for year 1. So the first tax benefit that you are going to receive will be from year 2. So this will start from year 2, 2 to 4, 2, 3, 4. Okay. So what is going to be the tax benefit? 30% of the lease rentals. This will be for every year, for 3 years, second year, third year, and fourth year. And now let's take the annuity factor, which will be starting from year 2. 2, 3, and 4. 2.453. And let's multiply. So that's the total present value of the benefits. And let's add these two. 24867. That's your NPV if you are going for the lease option. So now we have got two net present values, the buying option and the lease option. What's the decision? So what should be the comment? Since it's cheaper to lease the asset, therefore the asset should be acquired through leasing. Should be acquired through leasing. That's it. Okay, I'm just going. That's the tax benefits, 30% of the cash flows. Right? And that's, since it starts from year 2, therefore we are just adding the discount factors from 2 onwards. So this is the second year's discount factor, M12, then N12, then O12. So I've added all the discount factors from year 2, 3, and 4. Manahil, this is how we have calculated the tax benefit. May you come again on discount factors for lease rentals? Yes, here we go. Since the lease rental is going to start from year 0 and will end at the end of year 2. So 0, 1, 2. So 0, 1, 2. I've added the discount factors of 0, 1, 2. Jonathan, Portia, is it clear? Jonathan and Portia, is it clear now? Yes, Wakas, I'm explaining it. Okay, Wakas says, sir, can you explain why the tax benefit is starting from year 2? Okay, you know that the question has stated that the tax is going to be paid in arrears, right? So the first lease rental is going to be paid at point 0, and point 0 is usually the start of a year. So if you are paying a lease rental at the start of the first year, you are basically paying it for the year 1. Since the lease rental is for year 1, the tax benefit because of arrears will start from year 2. Wakas, is that clear? Okay. Yes, the lease rentals are paid in advance. It has been stated in the question. Shamir, just look at your question, L20 into 30%. Because the first year lease rental will be paid at the start of the first year in advance. What does advance mean? Advance means that you're paying at the start of the year, and the start of the year is considered to be 0. So the first year lease rental will be paid at the start of the first year. So that's why it is 0. The second year lease rental will be paid at the start of the second year, which is called 1. And the third year lease rental will be paid at the start of year 3, which is considered to be 2. So that's why it's 0, 1, 2. Janzeb, clear? Okay. So that's it. We are done with the lease or buy question as well. So do you people want a 2 minutes break? If you want, I can give a 2 minutes break. Okay, let's take a let's take a break till 11. Meanwhile, I'll answer the questions. Janzev has asked a question that what is tax exhaustion? Tax exhaustion basically it's like, for example, I have a profit. Just concentrate on this example, Janzev. I have a income of $100,000, right? I'm just writing the figures here. $100,000, okay? And I have an expense. Let's say it's 40,000, right? It's a tax allowable expense. Now, what will happen? The tax authorities will deduct this 40,000 from my income, and it will charge 30% tax on the rest of the income as a tax, right? 18,000, right? So it will charge me 18,000 tax. I got a benefit because of this expense. In case this expense was not there, I would have paid tax on the whole 1 lakh amount, and it would have been 30,000. But now I am paying just tax of 18,000, and this is because of this 40,000. So how much, Janzev, quickly answer me. How much tax benefit did I get because of this expense? 12,000. Very good. 12,000. And I can just simply calculate this 12,000 from by multiplying 40,000 by the tax rate directly. That's the 12,000. This is the benefit that I got, right? Okay, now my question is, if this expense increases to 80,000, will I still get a tax benefit or not? Janzeb, will I still get a tax benefit or not? Yes, I can still get a tax benefit because my income is more than this expense. But what if this expense increases to 120,000? No, I will get benefit, but only up to 100,000 value, the maximum income that I have. So even if my expense is, yes, even my expense is 1,20,000, the tax, since I don't have more income than $100,000, the tax authorities will only subtract 100,000 from my income, even if I have 120,000. So beyond this 100,000, I won't be able to get any tax benefit, and that is called tax exhaustion. When the expense is more than my income, the tax benefit will exhaust. We won't be getting more tax benefit. No, actually, here there is no tax exhaustion because we are assuming that the company has sufficient taxable profits available to claim these tax benefits. This is what we have assumed, because in the absence of any information, we will always assume that these expenses are less than the income of the other income of the company, so they can easily subtract this from their income to get the tax benefit. That's what we have assumed. You're most welcome. Okay, can you please explain the formula used in year 4 of tax benefit on capital allowance? The cost of the asset into 70 twice of 75%, because every year the value of the asset will be decreased by 25%. So we'll be taking 75% twice to get the WDV after 2 years. And from the WDV, we will subtract the scrap value and then apply the tax rate to get the tax benefit on balancing allowance. Sufyan, is it clear? Can we take 50%? Why we should be taking 50%? The tax rate is 30%. Why should we be taking the 50%, right? No, 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 no. We can't, because it's reducing at 25% rate. So the first year, the 25% will be applied to 320,000. The next time, it won't be applied to the same 320,000. The next year, it will be applied to the reduced value. It's that the concept of a compounding concept is there, right? Okay, we're done with the break. Let's move forward now. Okay. Now let's move forward. We have a question here. The board of OAP company has decided to limit investment funds of $10 million for the next year and is preparing its capital budget. What is the part B? There is only part A in this. Let's move towards the next question. I will be sharing this file with you so you can check the cells, the formulas as many times as you want to. We have only half hour left and we have to complete at least 2 more questions. So the board of OAP company has decided to limit investment funds to $10 million, right? Do you remember any topic? Do you recall any topic? From this sentence, which topic can you recall from your FM syllabus? Capital rationing. Yep, it's a capital rationing topic, right? So whenever you have a restriction on your available funds, either imposed by the management or imposed by the factors outside the management control, the situation is called capital rationing, where you have a limited resources available to invest. So in this case, it's the management that has imposed a restriction. And when management imposes the restrictions on the availability of the funds, it is called soft capital rationing. When because of the market factors, because of the factors outside the management control, you cannot get more funds. Either you don't have good financial performance, that's why nobody is willing to pay to invest in your company, or any other factor beyond the management control. That is called hard capital rationing. But as far as the question, solving the question is concerned, there is no difference between hard capital rationing and soft capital rationing. It's just a theoretical part. So let's move forward. Now, to cut short, the investment available for the company is $10 million and it cannot invest more than $10 million. And now it has option of investing in 5 projects, and all of these 5 projects, no, 4 of these 5 projects have positive NPVs, and the 5th project, it says that we have to calculate the NPV. So we'll see how we calculate it. So the 5th project requires 5 million of investment, and here we go. We have investments available for all the 5 projects. All 5 projects have a project life of 4 years. Okay, I will just check, Chandni. I will just check. Maybe because I took a screenshot of the question, I may have missed the question. So I'll just check later on. Project A, B, C are divisible projects. And divisible projects are those projects which can be undertaken in any proportion. That is, for example, if the total investment required for project is $2,500,000 and you only have, let's say, $500 available to invest in project A. So if it's a divisible project, you can still invest $500,000, though the total amount required is $2,500,000. But if it's a divisible project, you can invest any amount in this project. But definitely, then you will be having a reduced NPV. You won't be able to earn the whole NPV. You will earn it on a proportionate basis. But the non-divisible project is a project in which you cannot invest as per your choice. You should either invest the whole amount or you should leave the project. That's it. So in this case, these are all divisible projects. Project B and D are mutually exclusive. Okay. You can't undertake B and D together. Mutually exclusive projects are the projects that cannot be undertaken at the same time. So either select B or select D. You have to choose between the two. You can't have both together. Okay, all present values are in nominal terms, not relevant at this point. Project E, we have the information about project E. There is a strategically important project which the board of OAP have decided to and must be undertaken for the company to remain competitive regardless of its financial acceptability. Information relating to the future cash flows of this project are, so we have a project here and this project must be undertaken. Whether it's profitable or not, it must be taken as it is strategically important project. Okay. So your home assignment is to calculate the NPV of project E, right? That is your home assignment. I'm not going to solve this for project E, right? So what I'm going to do is I'm going to solve it as a capital rationing question. So first part is calculate the nominal after tax present value of project E and comment on the financial acceptability of the project. So it's a simple NPV question which we did earlier. So you just need to solve it at home. What I am going to do is I'm going to solve project B, part B. Calculate the maximum net present value which can be obtained from investing the funds of 10 million, assuming here that the nominal after tax NPV of project E is 0. Project E must be undertaken and the assume that the NPV is 0. So there is no negative NPV or positive NPV. So let it be. Okay. So now we have 10 million and we have 5 projects. Of the 5 projects, E has to be done. So we will just set aside the initial investment required for project E, right? So how much capital we will be left with? Remaining capital, right? The remaining capital is going to be, we have 10 million. Okay, let me write it in thousands. 10 million minus, it's 5 million, right? So we are left with $5 million. We are left with $5 million. And now we have to decide which projects we should undertake. Okay, how are we going to decide? That's what we have to do. So we have projects A, B, C, D, and we have already decided about E. So I'm not considering it anymore. Investment required. Okay, it's 2,500. I'm writing the figures in thousands. 2,200, 2,600, 1,900. And what NPV are we getting from each of the 4 projects? 1,000, 1,550, 1,350, and 1,500. That's the NPV we are getting. Okay. Okay. Now we have to calculate a thing called profitability index. What is this profitability index? We are earning $1,000 NPV from project A, but on if we invest $2,500. So what amount of NPV are we getting per dollar of investment? That is called profitability index. 1 million from $2,500 of investment. So what is the amount of NPV that we will be getting on per dollar basis? So if we invest $1, how much NPV are we getting? So write it up to 4 decimal places. So $0.4 against every $1 of investment. So we will be able to earn $0.4 of NPV by investing on every $1 in project A. Let's copy paste and see what we are going to get from the rest of the projects. So which of the project is giving us the highest NPV per dollar of investment? That will be our top most priority project. D. Okay. D is going to be our top most priority project, right? So the ranking of the projects will be, first will be D. And if we have decided to go for D, then which project are we no more going to go for? Ajmal, what do you want me to repeat? Last question. What? Okay. If we decided to go for, then you said something. Yeah. I'm telling you. Since D is on our top priority and the question says that you can't have B and D together. So if we are deciding that D should be undertaken, then automatically B will be discarded. This will no more be an option. We can't take B with B, right? B and D can't be undertaken together. So if D is on our top priority, which it means that we will be going for D. And if we are going for D, we can't go for B. So B is no more an option for us. No more an option for us. It's no more an option for us. Let's exclude it from our planning now. Okay, what is the second most profitable project? Now B is no more there. It is going to be C, and then it is going to be A. So that's how we should be planning for our project. So now let's write the projects in their ranking. D, C, A. Investment, make sure that we are not investing more than $5 million. The total should be 5 million. Of the 5 million, how much we are investing in D? 1900. How much we are investing in C? 2600. And how much are we left with? So we have to subtract from 5,000 the sum of the investment of D and C. It's 500. So we are only left with $500 of investment, that the rest of $500 will be invested in project A. Okay, how much NPV are we going to earn? Since we are investing the whole amount of project D's investment, therefore we will be getting the complete NPV of this project. The 1500 will be earned. Again, for project C, we are investing the whole amount, so we'll be getting the complete NPV of project C as well. But we are not investing the complete amount of project A, therefore we should not be getting the whole NPV, right? So we will be using the profitability index here. Just listen carefully. What was the per dollar NPV that we were getting for project A? How much we were earning per dollar of investment? 0.4. So by investing $1, we were earning 0.4. And how much are we going to invest in project A in total? 500. So I'll just simply multiply the profitability index, that is the $1 NPV, by the total investment of $500 to see how much in total we are going to get from project A. It's 200. So now the total NPV will be from this set of investment portfolio will be $3050. So that is the investment plan. And this is what the maximum NPV is going to be. Clear? Is it clear? Yes, even if we include E, it will only increase our investment, but there will be no change to our NPV because it has asked us to assume that the NPV of project E will be 0. So if we consider project E as well, there will be no change to the maximum NPV figure. The profitability index, that is the amount of NPV per dollar multiplied by the total investment. No, Abdul Muhit, this does not cover the whole capital rationing, but this will be enough for the exams. As I told you that with the limitation of time, I have to be focusing on key areas, the most probable areas that you may be seeing in your exams. I have another plan as well after 15th of August. I will share with you later on. I will try my level best that I cover maximum area during these 15 hours. But I cannot guarantee 100% of the syllabus coverage. You people have gone through the syllabus of financial management, and you know the length of this course. Okay, should we move forward? We have enough time left. I think we don't have enough time left. So let's do one thing. Let's do one thing. I'm just holding the questions here. I think it's enough for today. I'm leaving these two questions for you to solve at home. I'll be solving these questions tomorrow, but just practice them at home as well. So it's a simple NPV question, nothing new in this question. And this is a sensitivity analysis question. Just try it. I'll be solving it tomorrow. Meanwhile, I'll be just taking your questions. We have 10 to 11 minutes left. So if there are any questions that you want to ask, you're free to ask. No, Huma, the plan is a complete crash course after 15, which will cover everything. But I'm not announcing it because first of all, my priority is to go through all major areas of this financial management paper so that nobody needs that uh, course. Therefore, first of all, I'll try my level best to cover maximum syllabus areas during these 15 hours so that if somebody's already confident enough to go for the exam, they should go. Okay, one by one, just hold your questions. Just look at the questions. If you can see the questions of other students as well, just look at the questions. Let me answer the questions in a sequence so that each one of your question is answered. Okay, so I'm starting from the top. Sir, where can access FM past papers, especially the MCQs on ACCA website? All of them are not available. Yes, all of them are not available because they don't publish all the MCQs. So it's an inherent limitation. Okay, please tell about the Google Classroom. Google Classroom, okay, do one thing. If you haven't joined the WhatsApp group, just drop a text 923212604033. So that's my WhatsApp number. Drop a text if you haven't joined the WhatsApp group. Or if you have already joined the WhatsApp group, then you don't need to send a message on my number. Just drop a message on the group. I will share the link of the Google Classroom and the code as well. So you can join it then. So if anybody who hasn't joined or is unable to join the WhatsApp group, just drop me a message on this number. Okay, then another question. Plus, please do share answer sheet so we can reconcile our practice. Definitely, Hamza, I will be uploading this on the classroom, Google Classroom today. Why are we taking initial investment 5 million instead of 10 million? Because the question has said that we have to undertake project E in any case. And project E requires 5 million of investment. So we have set 5 million aside so that we can undertake project E. Why capital allowance was not taken in financing decision question? We have capital allowance itself is never relevant because it's a non-cash. It's a depreciation, it's non-cash and should never be considered in NPV calculation. It's the tax benefit on the capital allowance that should always be considered. Hamza, I hope it's clear. Sir, can you show that IRR formula once again and how you used to, Daniel, I'll share this worksheet with you later on the Google Classroom and you can check it later on. Shah Mohiddin, in your opinion, which is the most tricky part in FM? Well, risk management is the most trickiest part of FM, but it also depends on individuals as well. But if you talk about what is the base of financial management, it is the investment appraisal. If you are very good with the concepts of investment appraisal, in my regular classes, I take a lot of time to explain the concept of present value, the IRR. Even I derive the formula of IRR. I also derive the formula of IRR, which is not possible with the time pressure here. But I also derive the IRR formula for the students so that they understand how this works. So I spend a lot of time on investment appraisal, and this allows me to spend less time in the rest of the topics because the base becomes very strong. Janzeb, yes, you can always ask me a question. What topic will you cover in the next class? In the next class, in the Google Classroom, you can check the day 3 handouts. You will get an idea of what I'm going to discuss in the next class. When a capital rationing problem relates to one specific period, its available finance for that period is given as well. Do we use that period's investment to calculate profit index? Do we use the whole investment of the project to calculate PI? I didn't get this point. When a capital rationing problem relates to one specific period and its available finance for that period is given, as well as do we use that period's investment to calculate the profitability index? Or, well, we always use the initial investment figure to calculate the profitability index, remember. Can you explain sensitivity analysis versus probability analysis? Yes, Jonathan, but in the next class. How can we secure position? Which topics to get grip? You meant the nationwide and the global position, Janzib? Daniel is, sir, in which institution do you teach? I teach at Tabani's. Sir, I didn't cover yesterday's class, although I have already studied this topic from institute. Just wanted to know which questions you covered in yesterday's class so that I can practice them too, sir. Osman, just join the Google Classroom. In the Google Classroom, you can access the day 1 lectures. All the questions are mentioned there. Even the solved worksheet is also there. Sir, is the practice kit for F9 enough to pass paper if you have previous experience of this subject in CA Pakistan syllabus? Hamza, yes, the revision kit is enough, but provided that how many times you look at the solution to solve a question. If you are not looking at the solution to solve a question and you can solve a reasonable number of questions from every topic yourself, then definitely it's enough. Zohra says, sir, tips to pass the FM exam. Well, since yesterday, I've been telling you the tips that these are the do's and these are the don'ts. But whenever I say note this down, do note it down. Whenever I stress on something that note this down, do note it down, that those things are the tips to pass the exam. And when you'll be entering your exams, you will remember each of the things that I asked you to note down. That will help you a lot. And remember one thing, the smallest the part of FM, the biggest reason of the failure. FM, usually the students who fail FM, they fail because of small mistakes. They take things for granted. Like, let me give you an example. I ask you people to note down that we should always be using the borrowing rate for financing decision, not the WACC. This is a very small thing, right? So when you enter into the exams and you got a question on the financing decision and you got WACC and borrowing rate together, and there most of the students will ignore this point and they will lose marks. So it's a very small thing, but a very important thing. And it should always be after tax borrowing rate. Yes, it should always be after tax borrowing rate. Can you please explain again what is meant by A, B, C, D are divisible? Divisible projects are projects that can be undertaken in by investing any amount. For example, if a project requires a total of $2 million and you don't have $2 million, you only have $500,000 to invest, you can invest $500,000. You don't have to invest the whole amount, but definitely then you can't get the complete NPV of the project. You will get a proportionate share of the NPV. Like for example, you have an option of buying shares of a company and the total available shares are worth of $2 million and you only have $500,000 to buy shares. So you can only buy shares of $500,000. That is called divisible project. What is the purpose of simulation model investment appraisal? Simulation model is basically is a model in which when you expect different possible scenarios, like you expect different types of selling prices, different type of sales volume, and you're not sure what actually is going to happen. So you use simulation model to predict a possible scenario that you may see in a particular situation. For example, you expect three different types of NPVs from a project, but you're not sure which NPV will be there. So you can use simulation model to predict which NPV will be, which NPV you'll be getting. Is probability analysis related to the topic risk? Yes, it is related to risk. Could we be tested on graph of IRR in OTs? Yes, why not? Yes, you can be. So what you advise on comment if part of marks? Is it part of marks? Yes, comment is part of the marks. Yes, a one line comment, it usually gives you half or 1 mark. Can we do joint probability question tomorrow? No, it's not in my plan because the joint probability has been tested only once in FM paper. So I have picked the most probable areas that you may see in your exams. Again, equivalent annual cost is not a highly tested part. That's why I haven't picked the equivalent annual cost for these 15 hours. But just note it down. I will try to cover this area if we have time left in the end. So we have already approached to the end of the session. Well, both WACC and NPV are important, but definitely the proportion of NPV will be more than WACC in exams. Yes, Chandni, I will just check part B, and if you can just quickly send me the screenshot of part B so that I just check it and I'll get back to you. In the last class, we will be solving a past exam question completely on a computer-based platform. Yes, I will be teaching hedging. I will be teaching hedging. Yep. I have only one request from all of you. Um, the more questions you will ask, the less will be my speed. Because my way of teaching is that I usually try to answer all the questions. But when I go for answering all the questions, it slows down my pace. Yes, I will teach foreign currency topic. Yep. The risk management topic. Yep. I will be teaching. Okay, so we should end the session. And if you have any questions, you can ask me on the WhatsApp. And I have one request: don't ask irrelevant question on the WhatsApp group. Otherwise, I won't be able to answer your relevant questions, because with too many questions, it's difficult to see all the questions. So have a good day. Take care. Bye-bye.